It's one of those side effects of nearly over a decade of, I suppose, asset bubble boosting from central banks to major global funds. We have been pushing up asset prices, and that's based on debt. So we got to that point where debt is too high, so we're trying to push down the cost of debt at the same time, trying to hold everything together, and it's mostly unsustainable. So everyone's kind of starting to worry. And the move in gold is telling you that, yeah, there is a fair amount of risk in the system. We're in this unique situation that, very rarely happens. We've just had a rate cut from the US Fed and bond yields are going up. So, yeah, nobody's seen this before.
Yeah, I was going to ask you about that because, as you say, we had quite a dramatic 50 basis point cut from the US Fed, and a month later bond yields are spiking. What do you make of it?
Yeah, I guess it was slightly expected, but the 50 basis point move is actually quite unique. The Fed is telling you that they can manage a soft landing. Historically, they've never been able to do a soft landing once inflation went about 5%, and they've never actually delivered a soft landing when they start with a 50 basis point cut. So the fact that they started with it shocked the market. So, we don't quite understand the move. The Fed can't backtrack. So in this kind of scenario, they're probably going to keep cutting, and they'll probably cut 25 basis points for the next two meetings. So that's the market expectations. So the bond market is telling you, if we do that, you are going to add to inflation.
And of course, the other issue for investors is the US election outcome. There are reports that Wall Street banks and brokerages and investment managers, as well as the exchanges, are adding extra staff to deal with potential volatility ahead of and post the election outcome. What is the market expecting?
Yeah, I think the market's a bit confused, and I think that's fair enough, because at the end of the day, US elections are quite unique. They have the college voting system that makes it even more complicated to forecast. At the moment, both major parties are, neck and neck. It's hard to work out who is going to win. But one thing is for certain, neither party has any plans to cut back on debt. If anything, they're going to add to the debt. One is going to add a hell of a lot more than the other, but the debt is going to keep growing.
Can you explain to us how historically bonds and equities work with each other and what is happening that's so unusual now?
Yeah, so usually when you have low risk periods, you are long equities because you benefit from the growth cycle. And when growth looks expensive and equities look expensive, then generally investors tend to move towards bonds because they're supposed to be the lower risk, more defensive approach. But what we've done over the last 15 years is we artificially deflated the bond market to keep lower bond yields, which is basically central banks buying their own debt, which is kind of looks like a Ponzi, but it is what we do around the world. So we artificially deflated it. So what that created is both markets look expensive. So if you think things are going to go wrong, when in reality bond markets should be going up, but in the current situation, both markets are correlated. So if equities pull back, bond yields are going to rise, which means bond markets are going to sell. So it doesn't matter which market you go into, you're potentially going to lose money.
And that's why we're seeing the gold price rising, as you mentioned?
Yeah, and gold price is near all-time high in US dollars and Aussie dollars. So you've got this situation where that is probably one of the few asset allocation areas that is not being manipulated by central banks. So market is naturally gravitating towards that as a hedge of market risk, currency risk, and overall systematic and economic risk. So gold is benefiting from all of those worries, while all the other asset classes are relatively correlated. Even though they're supposed to be non-correlated, they've become correlated. So the market is worried, and that's why the only asset allocation that's non-correlated, which is gold, is hitting all-time high on a weekly basis.
Mathan, Somasundaram, thank you so much for your time.
Thank you.